All right, all of the money you're putting into your 401k right now is great, and it goes in tax-free. Now, when it comes out, you got to pay all those taxes. Thankfully, there are ways to help you save some of those dollars. And we're going to find out right now from Ben Fuchs, founder of Fuchs Financial and certified financial planner. How many people out there do you think, like a percentage of the population who have 401ks, think that that's all of their money?
The majority.
The majority?
I would say the majority of people, all their savings is all in the 401ks.
Okay, so they think, like I did until about 2 years ago, that X amount of money is mine to spend no matter how I want. But that's not the case. What is the percentage that is going to be coming out?
It depends on how much you take out and how much you need. I mean, as you take out more and more income, you're taxed in a higher bracket. And so what we like to focus on is understanding how that next dollar that you take is going to be taxed. So there are scenarios where so let me give this example.
Yeah,
because there's a lot of different things where you're taxed in different ways. So we all know that Scott Haney is the wealthiest man in Connecticut, right? I mean, generally speaking,
God in heaven, if that were
the
only
managers
the
of
case.
hedge funds all come to Scott to say, like, before we buy a stock, we just call and text and say, is this okay? And you give us the okay. So let's say that Scott bought NVIDIA for $1,000 a while ago, and it's now worth $101,000.
I wouldn't be here sitting with you, Ben.
You would, and I look forward to the next time.
Okay.
So let's say that he bought that. It's gone up $100,000. If he sells it while he's working, and he's never going to retire, but he sells it while he's working, he might be paying $15,000 or he might be paying over $23,000 in taxes on that sale. But if he waited until he retired and he had no other income, we could sell that over 1 or 2 years, and instead of paying $15,000 or $23,000, we could pay nothing.
I would like to do that.
Now, that comes into play with Social Security. If you're just taking Social Security and that's the only source of income, you're not paying taxes on that.
Okay.
But now you add in the sale of that stock, and all of a sudden they're both being taxed.
Got it.
So the way that you combine income from different sources is going to determine how much you're taxed. And for us, we need to focus on that very heavily for our clients, because if we can save somebody $10,000, $15,000, $20,000 in taxes, I'd say we're doing our job.
Can we go over the woman who...
We can do whatever you want.
Okay, so there was a woman out there. She got some bad advice. She was... her husband apparently passed away, unfortunately, and she didn't have enough money from Social Security.
Right.
So she got some bad advice from and was told to pull $50,000 from her IRA, which triggered a huge tax bill that only worsened her current situation.
Right.
Now, you're saying some of this could have been avoided.
Some of this could have absolutely been avoided.
How?
First of all, I'm good, but in my head, I'm not great. So first of all, we have a taxes and retirement seminar coming up in Glasgow.
October 14th.
Oh, thank you.
You're welcome.
So if you want to get in examples without me using my hands, we can go into it then. But when you have Social Security, again, you're not paying taxes on that Social Security if that's the only source of income.
Okay.
When you take out $50,000 from your IRA, you're paying taxes on that money.
Right.
And now it's causing Social Security to become taxable where it wasn't before.
Ugh.
So you might be in the 12% tax bracket, but you're paying taxes like double in a lot of cases. So the way that we can structure her income, the way that we can structure withdrawals, can really minimize the tax. And so what we do is we go through with every client every single year, here's where we're taking your money from, and here's how we're going to do it to minimize your taxes going forward.
Okay. We only have about 30 seconds, but donating to charities, some people think that that's a great way to shelter taxes.
There's lots of different ways to do it. So you can do things like donor-advised funds, you can do straight gifts to charity, you can get really fancy and do charitable remainder trusts. There's lots of different ways, but again, don't just do it. You need to have a plan. When we talk about required distributions, when you're forced to take money out of your retirement accounts, you can do things where you have that money go directly to a charity, and then you don't pay the tax on the money like you've earned it.
Isn't he so smart? He's just so smart.
Yeah.
Ben, we love you.
I love you.
Thank you.
I'm honored.